Hello and welcome to lecture for chapter 12. This chapter we talk about how to both interpret and create the statement of cash flows. So this particular financial statement is one that I always struggled with in the private sector. I always had our outside accountants do it every year. I think they changed how it was done right after I graduated college, so then I didn't know the new way. And so when I started teaching, I had to learn how to do these, and I find it's in kind of a math puzzle kind of way. It's the financial statement I like preparing the most, just because of how it works, and I think you'll see that as we get through here. So first, I'll talk about kind of how we categorize cash flows, and both in and out of the business, and why that matters. We'll talk about using the indirect method. So with this chapter, you don't need to pay attention to the section on the direct method. We're only going to study the indirect because that's what the vast majority of companies use. We'll talk about cash flows from investing activities, financing activities, and then finally how to format the statement. The key to this statement from the perspective of an investor or a lender is they want to see that the company can generate cash through the purpose for which they're in business. So making products, providing services, whatever it is, eventually to be sustainable, that needs to be positive. So companies need to understand their cash flows because it's those cash flows that allow them to pay their operations as they're incurred, pay their bills as they come due without being late, meet payroll, those kinds of things. It's surplus cash flows that will give the business the ability to expand, to add on to their factory, to buy new machinery, to develop new products, all of those kinds of upfront costs that you need before you start selling something. It'll also allow the company to meet its financial obligations. If they have long-term debt, to make those debt payments on time or bond payments on time, that's critical. And then finally, they need to be able to show to the owners of the company that not only can they do the above, keep the operations going, expand the operations, and pay their debts, but they also have money left over to reward their shareholders with dividends. So the statement of cash flows looks at activity in three different sections. I'll describe each of them. First is the operating activities. That's the core purpose for which a company is in business. So what did they get from customers in returns for product or services, and what cash flow left the business in an effort to provide those products and services. The next is investing activities. That's how much was spent or received for buying and selling long-term assets. So I bought a machine, I sold a building, I bought land, those kinds of things. The last category looks at any activity regarding long-term debt, so borrowing from the public or a bank, and transactions with the owners. So did the owners put money into the business? Did they take money out of the business in the form of dividends? Were there stock repurchases? Those kinds of activities. So here's a graphic from a textbook that I've used in the past. It gives you some examples of what sources and uses are, but think for each of those categories, we're going to have potential sources of cash flowing into the business and potential uses of cash flowing out of the business. And that cash is a critical lifeblood for the company to operate. So it's really important for anybody involved with the business, either the people running the business or the people that have invested in the business, to understand these cash flows. So the operating section is the most difficult, so we'll spend the most time talking about that. So the indirect method starts with net income and then adjusts net income for the impact of the operations in terms of converting GAAP accrual net income to cash flow. So we're going to adjust to reconcile the net income of the business to the cash flow from the business. That's how we come up with cash flow from operating activities. So the first step is to, as I said, start with net income after tax. And then you add back any expenses that don't impact cash, that don't cause you to write a check. As an example, depreciation. That you don't ever write a check for depreciation. You don't pay somebody for it. Okay, so that's an example of an expense that doesn't require cash. Another example would be amortization of intangibles, doesn't require cash. Step number 2, we're going to adjust for elements of net income that are covered in other sections. So I mentioned before, the investing section is where we record buying and selling long-term assets. Well, when we sell long-term assets, sometimes we might have a gain or a loss associated with that. And that gain or loss is going to be included in my net income figure so that I don't double count it, and I want to record the full amount I received for the equipment in the investing section. I need to adjust my net income for that so that I don't double count it. So I would add back a loss because that had lowered my net income, so I need to add it back to raise it. And I would deduct a gain because a gain added to my net income, I need to take it away now. Next, I'll add or subtract changes in current assets and current liabilities. So this is always a little bit confusing. So we're going to deduct increases in non-cash current assets. So if my accounts receivable increases, if my inventory increases, that has a negative impact on cash. Imagine if you have a year where you make $10,000 in profits, you start the year with 0 in receivables, and you end the year with $100,000 in receivables. Well, you didn't really, let's say you had profit of $10,000 or $1,000, and you go from 0 receivables to 900 receivables. Well, you didn't receive all of that cash, so you need to subtract that increase. By the same token, if you received more cash than what had been sold during the period, you're going to decrease your accounts receivable. So we're going to add a decrease in a non-current asset because that added to our cash flow. And then we do the opposite for current liabilities. We deduct decreases and we add increases. If you could think of maybe drawing a piece of paper along the left side of the paper, a CA, and below that CL for current asset and current liability. And then up above in this matrix, make a column just to the right of the CA-CL column that is headed with the word increase, and then a column that's headed with the word decrease. So under the column increase and the row for current asset, you could put a downward arrow, because I know that if increases in current assets are going to have a negative impact on cash flow, it's going to cause cash flow to go down. Well, then you could put an up arrow in the column to the right of that for a decrease. And then the arrows you write on the current liability row would be the reverse. And that's a good kind of tool to use. You'll see that on some of the solutions for the working papers or the in-class practice, that you'll see how I've diagrammed it that way. So here's an example of an operating activity section. So as I mentioned before, we start with net income. We add back a non-cash expense, depreciation, and then we had a gain on the sale of land of $12,000. That's included in the 108 up there, but I want to include the total amount I got for the land down in the investing section. So I need to subtract that gain because it added to the 108. Okay, so I subtract it back out. And then I've got changes in current assets and current liabilities. So an increase in accounts receivable has a negative impact. A decrease in inventory has a positive impact. A decrease in a liability, accounts payable, has a negative impact. Not only did I pay this year's purchases, but I paid down my balance that I carried from last year. It's a negative impact. An increase in accrued expenses payable has a positive impact, and then decrease in income taxes payable, just like with accounts payable, has a negative impact. So I add all of that up and I get net cash flow from operating activities of $100,500. That's how much the core purpose of their business generated in terms of cash. So next, we'll do the investing and financing activities. So we'll look to the general ledger for details about activities. Usually there's not a lot of transactions involving long-term assets, and financing activities are usually a few large transactions, so it can be easy to find them in the general ledger. And again, investing activities are cash inflows and outflows that relate to buying and selling non-current assets. financing, cash flows, inflows and outflows relating to long-term debt, and dealing with the owners of the company or stockholders' equity. So in this example here, we look to the general ledger detail for the land account, and we can see here that we sold land for $72,000 in cash. Notice there's a credit of $60,000. The 72 represents we credited this account for its cost when we sold it and recognized the $12,000 gain when we received $72,000 in cash. I looked at and I see that I purchased some land for cash, and then I can see in the building account I purchased a building for cash. So in those cases, I know I've got money coming in and money going out for investing activities. Then I look at financing activities, and I can see the common stock account increased when they issued 4,000 shares, and the paid in capital in excess of par increased. So it appears they raised $48,000 in cash by issuing shares. And I can see dividends payable, that they paid some dividends during the course of the year to the owner, so money flowed out of the business for that purpose. And then under bonds payable, I can see they retired bonds, so they paid off some debt. So I know I can see from these details what the investing activities were specifically, what the financing activities were. So then I prepare the overall statement. So the first roughly half of it at the top there is the operating section that we reviewed on a previous slide. And then I've got cash flows from investing activities. I have the cash received from selling the land of $72,000, and then two different amounts of cash paid out. So $72,000 came in, $75,000 went out. The net impact you see there is negative $3,000. And then financing activities. I have cash received from the sale of stock, $48,000. And then I have cash that left to retire debt, cash that left to be paid to owners of $74,000. So I had negative cash flow from financing activities of $26,000. So I add those three different categories together, $100,500 minus $3,000 minus $26,000, and I have an increase in cash of $71,500. That's the sum of those three numbers. I add that to my beginning cash balance, and I will get my ending cash balance on my year-end balance sheet. I can check that 97,500 figure to what cash shows up as on my balance sheet as, and it will be equal. So this reconciles the beginning balance in cash with the ending balance in cash by categorizing for people what did the core purpose of your business provide, what did dealing with assets provide, and what did dealing with debt and equity issues, how did that affect the business? This business that we're looking at here, this tells a good story. It tells a story that their core purpose of their business generated a substantial amount of cash. They use that cash to buy additional assets, and they use that cash to pay down debt and reward their owners. This is a good picture. Pictures that would be not as good would be where they have a negative cash flow from operating activities and positive from investing or from financing. The reason that's not sustainable is eventually you'll run out of things you can sell to raise money or people that will loan you money if you can't generate cash on your own. So that's the end of this lecture, a relatively short lecture, but the in-class practice problems take a little bit longer. So please spend some time with those and look at the solutions before you start your homework. And I will talk with you again in the last lecture for chapter 13. Thank you.